Imagine you get a message one afternoon. Not from a stranger in a trench coat, nothing dramatic. It looks like a normal job posting. Work from home, flexible hours. All you have to do is receive a payment into your bank account every week or two, keep a small percentage as your fee, and send the rest along to another account. No experience required. It pays surprisingly well for how little effort it takes. That job is real. Thousands of people take it every year, and a lot of them don't find out what it actually was until a bank freezes their account, or until a police officer is asking them to explain a transaction they don't remember approving. Because that job, dressed up as a payment processing gig or a personal shopping assistant role, is very often just one small, mundane piece of a machine most people only ever picture as something out of a heist movie: money laundering. I want to talk about how that machine actually works today, because the real version of it looks almost nothing like the movies. It's mostly spreadsheets, shell companies, and completely ordinary-looking bank transfers, engineered to make illegitimate money indistinguishable from legitimate money by the time anyone's looking closely. And understanding how that engineering works turns out to explain a lot more than just crime. It explains why your bank sometimes asks strange questions about a normal transaction, why cash businesses get extra scrutiny, and why that too-good-to-be-true job posting might be more dangerous than it looks. Here's where most people's mental picture goes wrong. We tend to imagine money laundering as something exotic, something that happens far away, involving people who look and act like criminals in an obvious way. That image is comforting because it makes the whole thing feel irrelevant to an ordinary life. But the actual mechanics of money laundering aren't exotic at all. They're bureaucratic. They rely on the same infrastructure everyone uses every day: bank accounts, invoices, business registrations, real estate transactions. The entire goal of money laundering isn't to hide it somewhere secret. It's the opposite. It's to make it look completely unremarkable, so unremarkable that it can sit in a normal-looking account, funding a normal-looking life without anyone giving it a second look. That's actually the whole difficulty of the problem, both for the people doing it and the institutions trying to catch it. Hidden money that stays hidden is useless. You can't spend it, invest it, or build anything with it while it's buried. The entire point of money laundering is to make dirty money spendable again, which means at some point it has to rejoin the normal financial system and start looking exactly like everyone else's money.
So let's actually walk through how that transformation happens, because there's a framework that shows up again and again across nearly every documented case, and it breaks down into 3 stages that financial investigators have used for decades to describe the process. The first stage is called placement, and it's usually the riskiest part for anyone trying to launder money, because it's the moment illegal cash first touches the legitimate financial system. If you've got a large amount of physical cash from an illegal source, you can't just walk into a bank and deposit all of it at once, because large or unusual cash deposits are exactly the kind of thing that triggers reporting requirements at financial institutions. So placement often happens through businesses that legitimately handle a lot of cash anyway. Car washes, laundromats, vending machine routes, small restaurants, the kinds of businesses where nobody blinks at a heavy cash flow because a heavy cash flow is normal for that business. Illegal money gets mixed in with real revenue from real customers, and on paper, it just becomes part of the business's normal earnings. The second stage is layering, and this is where things get genuinely intricate. The goal of layering is distance. You want as many steps as possible between the original source of the money and its current location, so that even if someone traces it, the trail becomes exhausting, expensive, and slow to follow. This usually involves moving money through multiple accounts, sometimes across different countries with different banking laws, sometimes through shell companies that exist mostly on paper, with layers of ownership designed to obscure who actually controls the money. Every additional transaction, every additional jurisdiction, every additional company in the chain adds friction for anyone trying to follow the money backward. It's not that any single transaction looks suspicious on its own, it's that the volume and complexity of the whole chain is the point. The third stage is integration, and this is where the money finally comes home, so to speak. At this point, after enough layering, the money has enough distance from its original source that it can be reinvested into things that look completely legitimate. Real estate is a classic destination because property purchases can involve large sums and ownership can be structured through companies rather than individuals. Investments, luxury goods, legitimate business acquisitions, all of these can serve as landing spots. Once the money is sitting in a piece of real estate or a functioning business, it's no longer dirty money in any way that's visible from the outside. It's just an asset owned by what appears to be an ordinary, successful person or company. Here's the turning point, and it's the part that I think reframes the whole topic. Money laundering isn't really a story about hiding money. It's a story about manufacturing a plausible story. Every stage of the process, placement, layering, integration, exists to build a narrative that a transaction, an asset, or a person's wealth is exactly what it appears to be, even when it isn't. The system doesn't need to be undetectable, it just needs to be plausible enough and boring enough that nobody has a reason to look twice. And once you see it that way, it connects to something much bigger than crime specifically. Almost every system built on trust, whether it's a financial system, a hiring process, or a marketplace, runs on exactly this kind of plausibility. We rarely verify things from first principles. We look for signals that something seems legitimate: an official-looking invoice, a registered business name, a bank account with a normal-looking history, and we extend trust based on those signals rather than deep verification, because deep verification of everything all the time would make the entire economy grind to a halt. Money laundering, at its core, is exploiting exactly that necessary shortcut. It's not defeating the system, it's using the system's own efficiency against it. This is also exactly why that work-from-home payment job at the start of this video is so quietly dangerous. Ordinary people, sometimes without any awareness of what's actually happening, get recruited to play the role of a placement or layering step in someone else's operation. Financial investigators call this being a money mule, and the recruitment usually looks completely normal: a job posting, a friendly recruiter, an easy task, a modest fee. The person doing it often has no criminal intent at all, but their bank account becomes one more link in someone else's chain, and when that chain eventually gets investigated, the consequences land on the person whose name is on the account, not just the person who orchestrated the scheme.
So what's actually useful to take from this, given that most people watching this aren't laundering money and don't intend to? The most direct, practical thing is simply knowing what a money mule recruitment attempt looks like, because the pattern repeats with remarkable consistency. It's almost always framed as easy money for minimal work. It almost always involves receiving funds into your own personal account and forwarding some portion of it elsewhere, often internationally. It's almost always vague about what the underlying business actually does, and it almost always arrives through channels that feel slightly too convenient: an unsolicited message, a job board post with no real interview process, a company with no verifiable online presence beyond the listing itself. If a financial arrangement asks you to use your personal bank account as a pass-through for someone else's money in exchange for keeping a cut, that's worth treating as an immediate red flag, regardless of how legitimate the framing sounds. It's also worth understanding why your own bank sometimes asks seemingly intrusive questions about a normal transaction, a large deposit, an international wire, a sudden change in your account activity. Those questions exist because of the same layering detection logic financial institutions have built specifically in response to how laundering actually works. It can feel like an inconvenience in the moment, but it's part of a system designed to make exactly the kind of scheme we just walked through harder to pull off and slower to succeed, even if it's never made impossible. And more broadly, it's worth carrying a small amount of healthy skepticism toward anything that asks you to move money on someone else's behalf without a clear, verifiable, ongoing business relationship behind it. Not paranoia, just the same kind of pattern recognition we've talked about with casinos and manufactured urgency. When something is designed to feel effortless and profitable with very little explanation of the mechanics underneath, that ease is often doing a lot of quiet work to keep you from asking the one question that matters most. I think what stays with me most about this topic is how ordinary the machinery actually is. There's no secret vault, no dramatic reveal. It's spreadsheets, shell companies, and bank transfers, dressed up to look exactly like the same spreadsheets, companies, and transfers that make up a completely normal economy. The line between the two isn't visible on the surface. It's only visible once you understand what's actually being manufactured underneath. Not hidden money, but a convincing story about where that money came from. That's genuinely unsettling if you sit with it for a moment, because it means the systems we trust by default, the ones that make everyday financial life possible, are the exact same systems this entire machine depends on to work. But there's something useful in that discomfort too. The same awareness that helps you spot a manufactured deal, a manufactured scarcity, or a manufactured urgency also helps you spot a manufactured story about where money came from, or where it's supposedly going next. You don't need to become suspicious of everyone around you. You just need to know that plausibility isn't the same thing as truth, and that the easiest, most convenient offers are sometimes the ones most worth slowing down to actually look at. Progress beats perfection here, too, in its own way. You don't need to understand every layer of global financial crime to protect yourself. You just need to recognize the one pattern that shows up most often at the edge of an ordinary life, an offer that's too easy, too profitable, and strangely light on details about what it's actually for. If any of this feels like it could actually be useful someday, maybe not to you, but to someone you know who gets an offer that sounds a little too easy, that's exactly the kind of thing this channel is built around. I'm Business Decoded, and if you want more of this, subscribing genuinely helps. Stay a little skeptical out there, and I'll see you in the next one.